Okay, so good morning. Now, today, we need to start and finish IFRS 15 on revenue from contracts with customers. So last week, we started and finished IS 36 on impairment of assets. And remember, on IS 36, we mentioned that the core objective of IS 36, which one? It's not in the hard copy. Okay. So that means I have to make use of the soft copy. Okay, let's continue, please. Let's continue, please. Okay, so in when we have IFRS, I was talking about IS 36. What we talked about is that we started with the objective of IS 36, and we mentioned that the objective of the standard is to ensure that your carrying amount is never higher than its recoverable amount. That recoverable amount, we see it as the realistic value of an asset. We don't want carrying amount to, for whatever reason, be carried at an amount that is higher than its realistic value. So we said the objective of that standard is do not allow your carrying amount to be higher than its what? Recoverable amount. If it happens like that, then you describe that asset as what? Impaired. So now we looked at how you identify an impairment, looking at the external indicators as well as the internal indicators. We looked at all of that. And we also considered when you have done these indicators, when you have looked at for these indicators, what you're actually looking for is impairment review. What you are doing is impairment review. And this your impairment review, you could find out or confirm that these indicators actually exist. When you confirm that these indicators exist, then you move to the level of impairment test. And at impairment test, what you are doing is that you are determining the recoverable amount of the assets. You are determining the what? Recoverable amount of the asset. Now, when you determine the recoverable amount of an asset, then you can easily determine its impairment loss. However, we mentioned that there are certain assets that you don't even need to look out for indicators of impairment at all. And those type of assets, there are two of them, that you test them for impairment annually, with or without indicators. And the first one is an intangible asset with an indefinite useful life. And the second one is what? Goodwill that is acquired in a business combination. These two assets are tested for impairment every year. Every year. Then we went on to talk about how do you then determine recoverable amount? How do you determine impairment loss? And when you have an impairment loss, what's the double entry for that? We said you debit POL and you credit the asset. However, we said if there is a previous revaluation surplus on that same asset, that means you won't just debit the impairment loss this year to P&L directly, but rather you hit it first against OCI. You hit that revaluation surplus in OCI first. If there is any excess, it goes to POL, then you still credit the entire amount to your asset. Then we went on to cash generating unit, where you have group of assets that you will need to put them together for you to determine the recoverable amount of that asset. And we said the sole purpose of cash generating unit is to help you determine recoverable amount. And as soon as you're able to do that, that's the end of its purpose in life. Then we get our impairment loss for that CGU. When you get your impairment loss for that CGU, you then allocate that impairment loss to individual assets within the CGU. We said, firstly, you will allocate impairment loss to a physically damaged asset. Then next, you allocate to goodwill, then to other assets on a pro rata basis. However, if we don't have, if you have current assets, we said don't allocate to current assets unless it's specifically identified as impaired. Otherwise, don't. Okay, but we now solve the past question. And in that past question, we saw that when the examiner has given you the net selling prices of an asset within a CGU, that means you do not impair such assets below their net selling prices, because the net selling prices then represent their market value. It represents their realistic value. And that is where we want to be. That is the aim of impairment loss, to make sure our assets show their realistic value. So when they give us the market value, that means you just make sure it is there. So the other question we looked at, they gave us an engine that is at its net selling prices. You see that the only one we impaired was the one that was damaged. The other one we didn't impair it further because it's at its net selling prices. And the other one was the license that somebody wanted to buy for 675,000. We only impaired up to that 675,000. We gave it specifically what will reduce the value to 675. And that is what you need to take care of as far as impairment loss is concerned. And finally, we looked at reversal, that you can reverse an impairment loss. And you need to take note of something. When we talk about impairment, impairment is quite different from revaluation deficits in meaning, because impairment loss is a permanent loss, a permanent loss in the value of an asset. We don't expect it to come alive. It's a permanent loss. It's different from revaluation deficit. Revaluation deficit is just changes in market value. Fluctuation is in the economic environment. That's the valuation deficit. But impairment loss is a permanent loss in the value of an asset. So if it now happens, like for a physically damaged asset now that has impaired, for whatever reason you're able to resuscitate it, you gave to someone, they repaired it, so it was working fine, that's okay. So if it happens that the value of that asset now goes up, then you have to reverse that impairment loss. One thing you should take note is that that reversal must not result in a new value that is higher than the original value of the asset before impairment. I give you an example of, if you have an asset of 10, you impair it by 2, it's now 8. You now say you want to reverse the impairment. You now say the new value is 12. No, it won't work. You only restrict it to what? Which is the original value before impairment. So that's one condition we need to take note when it comes to reversal. Another one is that when your goodwill is impaired, it's gone. It cannot be reversed. When goodwill is impaired, it cannot be reversed. Good name, you spoil it, you lose it. Today, IFRS 15, revenue from contracts with customers. You agree with me that revenue is a very important element for any company, because on the first look, what attracts any investor, anybody to a company will be its revenue. How much are they making? That is their revenue. Usually a measure of size, health, growth of a company. Very important. And that is why you also see it as the first line item in the statement of profit or loss, usually the largest in most instances. It should be larger than any item in anywhere in the financial statement. It should be the largest. In fact, there's a ratio called asset turnover that measures how many times your assets would have been converted to sales. The higher, the better. You see some companies that their turnover is almost 10 times their asset. 10 times. Do you know what that means? All their assets, their revenue is 10 times. That's huge. That's a company that is doing so well. And that is how it should be. That is revenue. So important. So the value at which you put it in your books, we don't joke with it. And that is why they came up with a new standard, IFRS 15, in 2014, though they started adopting it in 2017. It's a joint effort between the FASB and the IASB, meaning the US and the rest of the world. So we have similar revenue recognition framework now. This new standard helps a lot because now anyone that comply with IFRS 15, be sure that he has recognized revenue the right way. There are no loopholes. You cannot recognize false invoice. It's not possible with IFRS 15. It has a complete guidance. I'm not going to teach you the entire part of IFRS 15 here at this level, but I'm going to teach you the rest if you successfully scale through FR in CR. Now, the first thing I need to bring to your notice is the objective of this standard, which I can have asked before for 2 marks. But the way they asked it was state the core principle of IFRS 15. And that is what we call the objective of the standard. And the objective of IFRS 15 is that the revenue, revenue the revenue that is recognized in the statement of profit or loss must depict the consideration an entity is entitled in exchange for the transfer of promised goods or services. Depicts. Sorry? For the transfer of promised goods or services. So I said that the objective of this standard is that the revenue that is recognized in the statement of profit or loss must depict, must reflect the consideration an entity is entitled in exchange for the transfer of promised goods or services. What this simply means is that you can only recognize revenue when you have transferred goods or services. Your revenue must depict the consideration you are entitled to. So when we say you are entitled, it means that it is now your right. You have done your own part. You just left for them to give you your money. So your revenue must depict that. So before you can recognize revenue, you must have transferred the goods or services. That is the core of IFRS 15. That is what IFRS 15 wants to look at. So as you guys are seated here, our accountants at Equity cannot recognize revenue fully because we have not fully transferred the promised goods or services. We have not fully transferred it until the end of the diet, when we have delivered, when we have transferred, then that means we are now entitled to that consideration. So revenue is recognized to the extent of the promised goods or services that has been what? Transferred. And that's the core objective of this standard. You see, when you recognize revenue this way, it goes a long way to enable user fully understand your report, because that shows that the amount you have put there is what you have actually done. Is what you have done. And also, they would even understand that maybe you are still expecting more, because in the notes you will have even given more information that this work is still in progress. So they will understand the timing of your cash flows and all of that. So it's actually good because it reflects your actual situation as an entity. Now, having understood the objective, then immediately let's go to how do you then recognize and measure revenue. Okay, very important. There's no way I can want to ask a question on IFRS 15. This is where they will ask. This is absolutely where they would ask. So now, how do you measure revenue and recognize revenue? So IFRS 15 came up with a 5-step model. It came up with a 5-step model. Step one, he said, identify a contract, identify the contract with a customer. That's step one, identify the contract with a customer. Step two is identify the separate performance identify the separate performance obligation. That's step two. Step three is to determine the transaction price. Step four is to allocate the transaction price to the separate performance obligation. Allocate the transaction price to the separate performance obligation. And step five is to recognize revenue when performance obligation is satisfied. These five you must know. Even as accountants, in anywhere, this is very important for you because this is how you recognize revenue now. This 5-step model must be gone through and appropriately scrutinized before you can recognize revenue. So we're going to look at them one by one. I'm going to start with the step one, which is to identify the contracts with a customer. Pay attention. Identify the contracts with a customer. Now, in this step one, the key word here is, of course, contract. There has to be a contract. That's the key word there. And you know what a contract is already, usually an agreement. But IFRS 15 says that a contract is an agreement with enforceable rights and obligation. An agreement with enforceable rights and what? Obligation. For us, in reporting, contract is just an agreement. And it must be enforceable. It must have enforceable right and obligation. So fundamentally, it could be in writing, it could be orally, and it could be in line with any customary practices, usually depending on the person you are dealing with. Even if it is, you people just look at yourself and smiled. If that's how you people agree, it's a contract. Or you look at one another and blink. If that's how you guys agree, it's a contract. So for us in reporting, okay, so it doesn't necessarily have to be in writing. It doesn't. What is important is there an agreement between us? I mean, it depends on whom you are dealing with, right? If you are dealing with somebody and you guys have been in business together for long, so contract is an agreement that has enforceable rights and what? Obligations. Now, so for us, for us, that is not really our concern, right? Because we believe that financial reporting is principle based, right? And businesses is about relationships. If you see a business person that is not trustworthy, he cannot last in business, he will not do well. So we believe that gentleman people that are in business is agreement. You don't have to be in hardcore writing. An understanding is okay. So if the person misbehave, it's okay. Reporting is not, let the lawyer undo all of those. We are not concerned about that. So as far as reporting is concerned, agreement. However you agree. So the implications of what you is none of IFRS 15's business. Okay, now when is a contract in IAS 15? What are the criteria for a contract to be in line with IFRS 15? So a contract must have the following criteria. Must have the following criteria to be in line with IFRS 15. It must have the following criteria to be in compliance or in line with IFRS 15. Number one, the parties the parties must have approved the contract and must be committed to the contract. So this is the first requirement. The parties must have what? Approved it. So both parties must have agreed to the contract and they are committed to the terms of the contract. Number two, the parties' right for the goods and services must be identified. The parties' rights for the goods and services must be identified. So in the contract, it must have been very clear who is providing goods and services and what goods and services are you providing, who is paying and how much are you paying. It must be clear. So the parties' right for the goods and services must be what? Identified. Number three, the payment terms the payment terms must be identified. Anyway, what's the essence of selling if not to collect money? Abi? So this is extremely important. We must know when we are collecting our money and how. So the payment terms must be clear also. Number four, the contract must have commercial what? Commercial substance. Do you know what commercial substance means? Any idea? Commercial substance. The contract must have commercial substance. Do you know that I could enter into a contract with my girlfriend, with my wife, with my child, or with a close friend? Stressing me. So the contract must have commercial substance. And this commercial substance here, we are saying that if you enter into a contract with a close person and you are not even bothered about whether they pay or not, there is no commerce there. There has to be commerce. And when they say commercial substance, it means that money must change hands. There must be risk. There must be changes in risk and cash flow of both parties. Right? You have to be strictly adhered to that. Commercial substance, there must be commerce. Exactly. Yes. The focus is profit. We want to make money. So there must be change in cash flows and risk. People must be taking risk when you enter into such transactions. So they must have commercial substance. And number 5, it is probable. What's number 5? A better girl. What's number 5? It is probable that what? That the entity will collect the consideration it is entitled to. We have to be sure that we'll collect money. It must be, we have to be certain. It has to be probable that money will be collected. So there was a diet. Okay, usually it's always 5 criteria. So there was a diet, they asked 6 criteria. They asked 6. So I'm going to add one more. What? Any good? So the contract can be in writing, it could be oral, or any agreed customary practices. Whatever way you people have agreed to it. Okay, you have to know the 6. 5 marks by knowing these 6 in the exam. And it's not even sure that they might ask it. You might know it and not ask it. Well, no knowledge is lost. No knowledge is a waste. You have known it is with you. But if you now know it, they now ask it. 5 marks. Free. No, no, no. It doesn't have to be the exact words. Exactly. It doesn't have to. None of it has to be the exact words. So, I mean, what can help you is that me, I'm writing it by heart, Abi. So, most of you are still younger than I am. So, your brain should be sharper than mine. So, you should be able to. Most of you are young, so. Oh, okay. She said, do I know how long I've been doing this? So the reality about knowledge is that about the human brain is you forget. Seriously, you forget. See, the first time I taught this, I taught it better than now. Yeah, because I over prepared and I taught it so well. So it doesn't matter whether I'm teaching for the past 10 years. Every diet I read as if I'm because I forgot it. I forget. How is that IFRS 15? Okay, if you look at these items here, so if you look at this one, every contract must be approved. I mean, I think this one is a core requirement. They must approve it. If they don't approve it, nothing. And they must be committed. That's one. Two, everybody must know what they are supposed to do now. It's a requirement in a contract. You must know what you are doing. The person that will deliver goods must know. The person that will pay, you must know how much. And very importantly is the payment terms. Payment terms, as far as revenue is concerned, payment terms is so important. And of course, there must be commerce, commercial substance. Somebody must be paying. Somebody must be taking risk. Commercial substance is a requirement. And it must be probable that we'll collect our money. It must be probable. And the jara is that it can be in writing, oral, or any other customary practices. So this is very important. But if for whatever reason it happens that in business you have a contract that does not meet this criteria, you now collected money from a customer. You collected money from a customer. You know that money, you cannot recognize it in your books as revenue. If it does not meet, if that contract does not meet these criteria. So when you debit bank, that means you cannot credit what? Revenue. You cannot. So what do you credit? What do you credit? Sorry? Sales score. What do I call it? You sell liability. That's a good idea. So you will find out that a lot of people call it deferred income. Right? Some people call it deferred income. There is nothing like deferred income in reporting. People just make up that name and just become deferred income. Deferred income. No, there is nothing like that. Okay? It's actually called what? So please take note of this word. Your contract liabilities. Debit bank. Yeah. No, now, if you collect money and these criteria are not met, so you cannot recognize revenue. That money, you cannot recognize it as revenue. You recognize it as a liability. But why is it a liability? It's the same thing now. You have not worked. Yes, now. You have not worked. And again, look at it now. You entered in a contract with somebody and you did not agree the payment term. You did not agree the goods that will be provided. You did not agree a lot of things. So that means you can even provide the goods safe and the guy says, no, this is not what I have told you to bring. Go. Return it to and give me back my money. Yes. And it must have all of these criteria. Because if it is not well spelled out, the person can change it for you and say, no, this is not what I wanted. I don't want this one. Take it back. Give me back my money. So it's a liability until all these are met. Yes, yes, yes. Yes. Exactly. Yes. We are still going to get there. We are still going to get there. Okay. I understand what you're saying. You understand what I'm saying? That the contract should specify what happens on default. Yeah, it makes sense. So the payment terms has already spelled when you are supposed to pay. So if you now don't pay on time, okay, so that's another thing entirely. Okay. So what we call that is impairment of trade receivables. or what you call allowance for receivables. Okay, but when you get to CR, you will learn that it's actually an impairment. Yeah, it's actually an impairment. So that's what happens. Okay, so we are not really hoping that somebody will default, right? We are hoping that they will comply with the payment terms. And we're also hoping, because we said it's probable, if you look at it, that the entity will collect the consideration. Okay. Now, that's that. Now, there are two more things we need to know around the contract. Number one is contract combination, and number two is contract modification. Those two they can ask. They have asked it before, they can ask it again. So, sorry? No, no, not type of contract. It's just a subheading, not anything. Okay? So it's just a subheading. Contract combination. It's just a subheading under step one. Okay. Of course, it's clear. Contract combination, combining contract. Abi? So the key thing here is this. When you enter into a contract, into two or more contracts, two or more, at almost the same time, with the same person, okay? They are saying that you should combine them if they meet certain criteria. Okay? You entered into two or more contracts at almost the same time with the same person. Combine them if they meet certain criteria. So, what I want to look at is criteria for contract combination. Let's write it. Number one, contracts negotiated as a single package. Sorry? Okay. The contract was negotiated as a single package with a single commercial objective. With a single commercial objective. Okay. So the contract was negotiated as a single package with a single commercial objective. Number two, the price of one contract, the price of one contract is dependent on the price or performance of another contract. The price of one contract is dependent on the price or performance of another contract. Number three, the contract can be delivered. Sorry, the goods or services in the contract, the goods or services in the contract can be delivered as a single package. Okay, the criteria for contract combination. We said the first one is that the contract was negotiated as a single package with a single commercial objective. So you sat down with the customer and you negotiated multiple contracts. It's just like, probably, let's say you want to build a house or hospital for somebody. You now entered into multiple contracts for piping, let's say separate. You enter into contract for finishing, separate. You enter into contract for the structure, separate. So you enter into, but you sat down and negotiated as a single what? Single package. That you guys negotiated a single price for everything, but separate what? Separate contract. And they all have a single what? Commercial objective. The objective is to deliver a project, a product, a house, as the case may be. And the second one is that the price of one contract is dependent on the price or performance of another. So the price of one is dependent on when you have finished the previous one. They are one, they are combine it. If the price of one is dependent on the price of performance of the other, and the third one is that the contract, the goods there can be delivered as a single package. They are negotiated as a single package. They can be delivered as a what? They are the same thing, just combine it. So you as accountant in any business, and you see that they have entered into several contracts, and they have these criteria, see them as one contract. Combine them together and see them as what? One contract. That's contract combination. The next one is contract modification. You have contract what? Okay. Contract modification. When we say modification, you would mean by there's an adjustment or change. But primarily, as far as a contract for sales is concerned, it will be a change in the scope and the price of a contract. It will be a change in the scope and the what? The price of a contract. So what's the issue here around contract modification? So the issue is that that change in price and change in scope, are we seeing it as a separate contract? It's just like in the middle of this diet now, we now say we want to increase our fee to 120. That everybody come and pay. So that's a modification. So that change, are we seeing it as a what? As a separate contract. That's the core thing we want to look at here. When can a contract modification be seen as a what? As a separate contract. Let's look at that. A contract modification, a contract modification will result in a separate contract, in a separate contract, in a separate contract, if number one, the scope of the contract, the scope of the contract, the scope of the contract increases because of addition of promised goods or services, that are distinct, Number two, the price of the contract increases by an amount that reflects the standalone selling prices of the what? of the entity's goods or what? Or services. These are the two criteria for what? For contract modification. Okay, now let's quickly look at these 2 points. So, a modification, a change in price and scope. Are we treating that change as a separate contract or not? We said yes, it should be a separate contract. If the scope of the contract increases because of addition of promised goods or services that are distinct. You see, the key word here is distinct, because change in scope, of course, will be because of addition of promised goods or services. But the key thing here is that that addition of promised goods or services must be what? Then what is the meaning of distinct? I will get there. You have to be patient. But the key word here is what? Distinct, must be distinct. So know that word. Just let it be part of you for now. Distinct. The second one is the price. You see, the price of the contract increases by an amount that reflects the what? That's the key word there. The change in price must be a standalone selling price of the entity's goods or services. That means that, yes, yes. That means that that change in price for that new goods, right, must be the price you will have sold that good ordinarily. That if, let's even leave this contract, if you are selling to another person entirely, that's the price you will have sold. Okay? So it's a standalone selling price. That's the price you normally sell your goods and what? And services. That's the price you normally sell them. Then if these two exist, then you're going to treat those contracts or that change, I mean, as a what? Separate contract. You treat it as a what? Separate contract.